In this video, I'll discuss the basics of futures, how they're traded, and how they are frequently priced. We'll use the CME group in most of our examples today. Let's start off with the basics. What is a futures contract? A futures contract is a commitment between two parties to buy or sell an asset at a certain time in the future for a certain price. A futures contract can be written on many types of securities and commodities. A large percentage of futures contracts, or futures for short, are written on commodities like coal or iron. These contracts will specify the month in which delivery is to take place, the price for the commodity, and the location where the commodity will be delivered, if the commodity is to be delivered. Settlement of a futures contract can either involve delivery of the good or a specific amount of cash changing hands in the delivery month. Traders can buy and sell futures on several exchanges. We'll talk about that a little later. Now, there are two primary reasons why futures are traded. The majority of the volume of futures being traded is due to hedgers, and hedgers are oftentimes firms that produce or use some commodity and want to eliminate the risk associated with the price of that commodity changing. For example, if a farmer produces corn but doesn't want to worry about having to sell his corn at a low price per bushel at harvest time, he can enter into a futures contract to sell his corn at a specific price per bushel at harvest time in 6 months. Speculators, on the other hand, are investors that believe they can earn a profit by trading futures. So let's say you are a trader and you believe that the price per bushel of corn will rise between now and 3 months from now. One of the ways you can profit from this is by buying a futures contract, and that futures contract will give you the right to pay a certain price per bushel for this corn, and if the price per bushel of corn rises in the next 3 months, you still get to pay the set price in your futures contract. Now, here's a breakdown of some of the most well-known commodities traded on the CME, and I also wanted to give you some of their characteristics. So let's start off with cotton. So cotton, when it's traded on the CME, or Chicago Mercantile Exchange, it's traded in a set amount. Each contract is for 50,000 pounds worth of cotton, and I have over here the current price per pound of cotton. So this 0.6698 represents dollars per pound of cotton. So if you wanted to know what the current price for a futures contract that has a March 2020 settlement as of the day that I recorded this video, all you need to do is multiply the contract size, 50,000, times the price in dollars per pound, 0.6698. So let's look at corn. So corn is traded on the CME, and when it's traded in lots of 5,000 bushels. Now, corn, when it's bought on the CME, the price that you see here, 378 and 2/8, is cents per bushel, or US cents per bushel. So what this really reads as is $3.78 and 2/8 cents per each bushel of corn. So each of these 5,000 bushel contracts is going to be this number, 378 and 2/8, multiplied by 5,000. Now, if you're in my investments class, you hopefully remember something about options. Both options and futures can be written on a specific commodity. Both of these securities are considered derivatives since they derive their value from the value of some underlying asset. Both securities can also require delivery of the underlying asset in the future. However, unlike a call option, which gives you the right but not the responsibility to buy the underlying asset, taking the long position on a futures contract requires you to buy the underlying asset at a set price at a set time. Unlike a call option, which has an upfront premium, futures contracts do not have upfront costs. The only cost comes at settlement. Finally, an option can be written with a specific strike price, whereas the price of a futures contract is based solely on the supply and demand of the underlying asset. Now, the largest exchanges where futures trade are the Chicago Board of Trade and the Chicago Mercantile Exchange. The primary benefit of having many traders buying and selling futures on each of these exchanges is the liquidity on each of these exchanges. It's easy to close out your position in a futures contract at a price that was very close to the last price paid, since there are many traders in each of these marketplaces. Just like the stock exchanges that we've talked about, the futures exchanges have trading hours. These hours depend on the asset underlying the futures contract. One other point to note is that all futures trading is done on a margin basis, and we'll talk about why that's important in a bit. Futures exchanges have been around for a long time. The oldest futures exchange in the US opened in 1848 with the creation of the Chicago Board of Trade, or CBOT. Over time, other exchanges like the Chicago Mercantile Exchange or the New York Mercantile Exchange also opened. Traders could trade the same commodities on each of these exchanges. However, over time, these exchanges themselves were bought up by an organization called the CME Group. Today, the CME, CBOT, and NYMEX are all operated independently, but owned by the CME Group. The overwhelming majority of commodities futures are traded on these three exchanges. Now, futures exchanges are run in two broad ways, either through an open outcry auction or through an electronic market. The open outcry auction method is an old method where traders would use complicated hand signals to enter into futures contracts. To give you a sense of what this market looks like, here's a video of the movie Trading Places. So it's an old 1980s movie starring Eddie Murphy, and in this movie, what you see is the pit floor of a commodities exchange. And as you can see, these traders are sending hand signals to the individual taking the trades, and they use very complicated hand signals to communicate that they want to either buy or sell a particular commodity for a particular price. So notice the waving of the hands. Now, this was the primary method in which commodities were traded until the rise of the internet. In fact, the CME Group did away with this trading method for most commodities in 2015 due to a lack of demand for this type of auction. Today, over 99% of all futures are traded via electronic networks. The first of these was the CME Globex. Any order you or I are likely to make for a futures contract is going to be via one of these electronic futures markets. When a futures contract is traded, there are two positions, a buyer and a seller. The buyer is said to take the long position, since they will see a positive return if the value of the commodity they have a contract on appreciates above the value specified in the contract. The seller of the futures contract is said to take the short position, since they only benefit if the value of the underlying asset is below the futures price when the asset is delivered. Each of these positions can be liquidated by taking an offsetting position in the same contract. For example, if I have the long position on a contract for delivery of 5,000 bushels of corn in March of 2021, I can liquidate it by taking a corresponding short position. The two contracts cancel each other out. This technique is so common that only about 1% of futures contracts are actually settled by the delivery of the underlying commodity. Another term you should be familiar with is open interest. Open interest is the total number of contracts that are open and have not been settled by delivery or an offsetting transaction. Until I take a corresponding short position, my long position would be considered in the open interest number. Now, I mentioned earlier that all futures are bought on margin. This is an incredibly important point. When you decide you want to trade futures, you have to deposit a specific amount of money in your account. Now, your account is going to have a maintenance margin associated with it. When you buy futures, your futures will be marked to market or priced at the end of each trading day. Then, your broker will determine whether the value of the futures in your account is greater than the maintenance margin. If it isn't, then you'll need to add funds to your account to get back to your original or starting position. So you might be wondering, what happens if the value of your futures fall far below the maintenance margin before you can add funds to your account? Well, the answer is, realistically, in the real world, this really is not possible due to the current rules of futures exchanges. In the United States, there's a limit on the price movement of futures for each commodity. This daily price limit prevents the futures price of a commodity or a futures contract on some other asset from falling too far and wiping out traders and the brokers that they have a margin account with. The CME has very specific daily price limits for each contract. So to give you a sense of the daily price limits for various commodities, here's the daily price limits for the commodities that are most likely to be traded on the Chicago Mercantile Exchange or under the CME Group banner. So, for example, if we search for corn, what we see is that there is a maximum one-day change in price of corn of 25 cents per bushel of corn. Now let's talk about what counts as a commodity and the characteristics in each commodity futures contract. When we talk about commodities, we're referring to interchangeable goods that are qualitatively similar regardless of supplier. Each of these commodities is fairly simple in nature. For example, lumber is fairly uniform, assuming it's cut in the same length and it's from the same tree, or same type of tree. All futures contracts will list factors such as the size of the contract, the delivery month, and the location to which the commodity should be delivered. Now, they'll also often give some information on the quality of the product. Let's take a look at the characteristics of the commodities traded on the CME. So I downloaded the position limits for each of the commodities traded at the CME. So what you can see here is that the CME trades about 630 something different types of commodities, like live cattle commodities, or lean hog futures, or cheese futures. And if we go down here, I guess these also include index futures as well. But you can see the contract size here that's given, and we know that this indicates 40,000 pounds of live cattle futures. And the settlement tells us whether or not it's going to, the end result is going to be a financial settlement, meaning that cash is changing hands at settlement, or the units being discussed will have to be physically delivered. So in the case of live cattle futures, one of the parties in this contract is going to have to physically deliver 40,000 pounds of live cattle to some location, perhaps in Chicago. Now what I'll do is I'll post this document to our Canvas site so you can take a look at it in greater detail. There's a lot more information here than I could possibly show you. Now if we want to know more information on each contract, what we can do is go directly to the CME group. And so here we have specifications of corn contracts or corn futures contracts listed on the CME group. So again, 5,000 bushels per contract unit, cents per bushel. And here are the trading hours specifically for corn. So corn trades from 7 p.m. starting on Sunday all the way up to 7 a.m. On Friday. We know the minimum price fluctuation. We know the settlement method, so corn is going to have to be physically delivered. And then if we go down here all the way to the bottom, we have some information on the quality of the corn. So through the December 2018 contract, number 2 yellow grade at the contract price, and there's some characteristics that will determine whether or not the corn is number 2 yellow or number 1 yellow or something. Some of these other number 3 yellow. Each contract is going to be very specific, or each commodity is going to have its own quality grades. Now let's talk about financial futures. Financial futures are futures contracts on financial securities. I'll discuss 3 of these here. First, we have currency futures, and currency futures contracts allow us to enter into a contract to buy a specific amount of a currency at a set exchange rate at a future point in time. For example, I might enter into a contract to buy 1 million Japanese yen at 110 yen per dollar in 2 months. This means that I'll be purchasing $9,090 worth of yen. I would enter into this trade hoping that the value of the yen rises relative to the dollar in the next month. If each dollar buys fewer yen, then the value of my 1 million yen increases once I convert it back into US dollars. If this happens, the value of my futures contract will increase. Another type of financial futures contract is an interest rate futures contract. And an interest rate futures contract locks you into a contract to buy a debt security at a set price. If you take the long position, you're hoping that interest rates fall and the value of the debt security you will be required to buy rises beyond the price you agreed to pay. Again, just like commodities futures, you can get out of these contracts by taking the opposite position. Finally, we have stock index futures or index futures. And these futures are futures that are tied to the value of some stock index. Arguably the most recognizable of these is the E-mini S&P 500 futures contract, whose value is tied to the value of the S&P 500. The buyer has a claim on a certain number of shares and receives cash equal to the value at maturity. The maturity date of these contracts is usually going to be the third Friday of the month. All right, let's talk about how futures contracts are priced. The way that we price futures is by using the formula that I have up here. So the value of our futures contract, or the forward price, is going to be equal to the spot price, or the price of whatever asset underlies this contract right now. And assuming we use annual compounding, what we're going to do is we're going to multiply the spot price by 1 plus our risk-free rate, so we'll say the yield on a 1-year T-bill, and take that to the power of the time in years until delivery. Now, in the real world, we would want to use continuous compounding, and for that, we use this formula. So the forward price of some commodity is going to be equal to the spot price times e to the power of our risk-free rate multiplied by the time until delivery of the particular commodity that we're discussing, or this could be a financial future. So let's look at an example. So in this example, the current price of a bushel of corn is $3.71 per bushel, and you want to lock in the price that you can sell your corn at in 6 months. You also know the yield on a 1-year T-bill is 1.54%. What should the forward price for a 6-month futures contract on corn be? And in this example, we'll use continuous compounding as opposed to annual compounding. So we'll start off with the formula I just gave you. So the forward price is equal to the spot price times e to the power of r times time to delivery. Well, our spot price here, or the current price of a bushel of corn, is $3.71 per bushel. We know that our risk-free rate is the yield on the 1-year T-bill, so that's 0.154. And then lastly, we want to know the forward price 1 or 6 months from now. So this is where we get this 0.5. And so when we work this out, what we find is that the forward price for a bushel of corn 6 months from now should be $3.74. So if you wanted to enter into a futures contract, realistically, this is going to be the price that you might have to pay to enter into that futures contract. Now, obviously, supply and demand are going to adjust this number, but this is, I mean, if we're entering into a contract, realistically, this is probably going to be pretty close to the price that we're going to have to pay. Now, lastly, let's talk about the return on a futures contract. And the return on a futures contract is pretty straightforward. All we do to get our return on this investment is we take the selling price of the contract, so the value we sold the contract for, subtract the price we paid for the contract, and then divide that by the amount we deposited with our broker, so the amount of the margin deposit. And that'll get us our return on a futures trade. All right, so that's it. What did we cover? Well, we covered several things. We talked about the basics of futures and what they can be written on, so commodities, financial assets, and then we also talked about how these futures are traded on exchanges, so the characteristics that define the futures and specific commodities that futures are written on, and then finally we talked about how to price futures using the risk-free rate, the spot price, and the time to delivery on the underlying asset. Now, if you'd like some more information, I'd recommend the CME's website. They have hundreds of mini lectures to help you learn about more specific details of futures contracts. So if you want to, you can actually follow this link, and the CME group puts together, I believe they have hundreds of these free mini courses that you can take a look at and learn a lot more about very much more specific information than what I've provided here. And that's all I have. So thank you very much.